Welcome to the Real Advisor Podcast, TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Swing low,
yes, indeed, dear
chariot.
Trappist. Welcome back to what many people are calling episode 64 of the award-winning Real Advisor podcast, TRAP TRAP. My name is apparently Lick Ninken, and joining me as ever in the studio of doom are the 3 other horsemen of the apocalypse: Alan, the storyteller Smith; Carl de la Voce, the voice widger, who's won some rugby game; and Andy Ultra Hart. Now, gentlemen,
So
we have a show
75%
full
of us, 75% of us won a rugby game at the weekend.
nothing. Okay, go on. You do the
We're not
intro.
going to talk about it?
You do the intro. You finish the intro off.
Wow, what a game. What a game. What a game on Saturday. Close game between England and France. We picked at the
Unbelievable.
end. Finally, we know what it is.
Unbelievable.
Finally know what it feels like to win a game by 1 point on the winning team. And then Ireland smashed Scotland on Sunday. So how did that go, Carl?
Yeah, that's exactly how it went. Again, they smashed Scotland.
Is it 11 now? 11 in a row?
I don't know.
It's close.
Only lost 4 times in 25 years to Scotland. Seems bizarre. Anyway, delighted for England getting a win on the board because it was looking like 0 from 2 again. But yeah, well done. Congrats to England. Really delighted for you guys.
Alan, I think Alan's muted intentionally. He doesn't want to speak during this rugby segment. That's
Ireland
fine.
are
Okay, we'll move on
2
to the
from
next.
2, heading for another Grand Slam potentially this year. So
As
yeah,
I
all
always
good.
say,
France
this comes
is
up
going to give you a run for
every
your money.
year. The only trophy that we want to win is the Calcutta
Calcutta
Cup,
Cup.
which we have won for the last 4 years. Count them, boys.
The
4
only one
years
you wanna
on
win is beating
the
England.
bounce, home and away. Not quite so confident this year, but we'll see. We'll see what happens.
That South African fella, Yves on the wing, is brilliant. I mean, really.
He's better than he's better than your Australian, isn't he? Or your South Islander,
Samoan.
or the whatever you got. You've got a couple of Irish in the team, though. To be fair, you have now.
Yeah.
That new number 10's pretty good.
Bundyaki,
Yeah.
that
he looks
that
very,
great
he's very
Irish
young
lad.
and very
He
skinny,
looks
isn't he?
about 12.
Yeah. But
He's
bloody,
decent.
bloody good. Yeah. Another Johnny Sexton on the way.
Pendergrast. Yep.
Yeah.
All right. Over
Yeah,
to
Nick
Lick.
is fuming. We ruined
He's
his flow.
fuming.
There's no we. There's no we, Andy. It was
off
you.
him.
There's no we. It was you.
Yeah,
And you've got to assume now I've done my intro, which means it's your time for the reviews.
I wasn't going to mention anything.
Okay, over to me for the reviews. 2 reviews today. The first one is from Chris Pedals, 5 stars. Best podcast in the business. I recommend this podcast to every advisor I meet. For experienced, and successful, professionals, sharing their experiences with what works and doesn't in this great profession of ours. It also has entertainment value in the frequent banter and tall tales from Mr. Smith. Final review. Matt the Lancer, 5 stars, entirely sensible and yet completely nuts at precisely the same time. TRAP has to be the go-to podcast for the next generation or agile members of the current generation of quality financial advisors. The TRAPist unrelenting focus on financial planning leads, elegant, simple, equity-focused, low-cost, straight-talking financial advice is spot on. Loads in each episode to take away and actually use in your day-to-day business. Incidentally, there's a fair number of switched-on SJP partners, often who use SJP passive range and price extremely keenly for their precious clients who sign up to the TRAP ethos. Keep up the good work. Back to you, Nicholas.
Very good. Thank you, Andrew. And thank you, Trappist, for those lovely reviews. They really do give us a shot in the arm. So keep on sending them in. 6 out of 5 stars is a minimum. Okie dokie. Let's put a timestamp on episode 64 with some topical titbits. And we're going to kick off with Ultra LifeStrategy.
Vanguard LifeStrategy. These are a wonderful fund range that sort of pioneered the one fund solution. It could be argued that various different companies did this, but the Vanguard LifeStrategy range of funds are an enormously successful range of funds. Very simplistically, there's the Vanguard LifeStrategy 20, 40, 60, 80, 100, and that denotes the representation in what I call low risk assets. 100% is 100% in low risk assets being global equities. Anyway, these funds have done fantastically well, and they came out with their sort of long-term annual figures recently. It makes some quite interesting reading. I'll just highlight a couple of things. The annualized return from the low risk portfolio, which is 100% global equities in my world, has done 10.3% since it started. Superb numbers. The high risk portfolio, which is 20% in global equities in my world, has done 3.79. And obviously there's a divergence between the split here. The total returns have done exactly what they said they were going to do. Some advisors in the UK have got a bit of a problem with it because they've got a bit more of a UK slant to them. I think the 100% equity portfolio is 15% UK when it should be 4%, but this is splitting of hairs. If you're going to say to someone, you're not interested in investing, you want to get a good return long term, you can't be asked to faff around and move companies when some die, some fly. It's an invest and forget, set it up once and you're good to go. I'm a huge fan of this fund range, and I think they've actually weirdly rebranded themselves as an MPS, which is obviously the flavour of the month in the UK, Managed Portfolio Service. It could be argued they do everything that an MPS does, or not anywhere near as much as what an MPS does. We're not going to get into the old MPS debate, but I was at a recent networking event, and a guy I met who's an MPS provider, I think he said there's like 250 MPS providers in the UK now. I'm like, whoa, how have I missed this? I thought there was like 7 or 8. It's 225.
It's boring.
It's just it's rebranding, isn't it? They used to call that
so there's a lot of genuine
multi-manager.
MPSs. There's a lot of disguised MPSs, and there's a lot of let's get onto the bandwagon. So, yeah, it's quite interesting reading. You
can see it is they're brilliant funds and a brilliant fund range. You can see why they would kind of rebrand just so people don't kind of misallocate where they should kind of sit in the whole fund range thing. So I think good point, Carl. You mean someone says you need to invest in an MPS and Vanguard don't want to get sort of overlooked or something? Exactly.
Yeah.
And yeah,
if you boys have gone through the PDF, very interesting. So the worst calendar year out of any of the Vanguard LifeStrategy funds was the year of 2022, and it was in their world the lowest risk portfolio. No, in my world the highest risk. It did, keep it simple, minus 16%. The worst year, the 100% global, the worst calendar year, not from high point to a low point, peak to drop. The worst calendar year the 100% global equity portfolio had was minus 6. Again, it's a travesty that people have been sold this high risk, low risk BS, and the returns are night and day. Had you invested in the Vanguard LifeStrategy 20 on launch compared to the Vanguard LifeStrategy 100 on launch, your money would be 6 times the size.
Wow.
Now. This is insane. But they filled in a mumbo jumbo questionnaire. They got put in the wrong portfolio. They had a bit of grey hair. They can't go near global equities. All the usual stuff we bang on about. So
I didn't even see the show notes, Andy. So I didn't. Are all those numbers in that PDF?
Yeah,
that you shared?
It's a very detailed PDF. It's really
everybody.
Really
that's
amazing.
like
When did the fund range launch?
The fund range launched 23rd of June 2011. So this is decent.
Right. Okay. So they haven't had we haven't had a prolonged bear market in that time in equities. So that skews the figures. And also Vanguard. A reason the Vanguard LifeStrategy gives me slightly the willies is they invest in long dated gilts, which are a waste of time, which will plummet when rates go up.
Not in the 100% global equity portfolio.
No, of course not. In the 20% equity one they do. That's why it was down 16%.
Of course.
So.
But yeah, look,
it's not perfect. You show me the portfolio beats my portfolio. I'll show you the portfolio beats both of them by nightfall. It's always the case. Like this one beats that one. That one's beat this one.
I've often recommended or suggested, friends, family,
Careful.
relatives who
You're unregulated, aren't you, Alan?
Who say, I said, go and have a look. I've got £300 a month to save for something. What should I do? I said, just go and check out, because the D2C model, you can click through this. But of course, it does have a natural risk profiling tool at the front end of it, which I guess they have to do. And it will direct people towards there. And really, how you framed this, Andy, at the beginning, and I often say it as well, it's not high risk portfolio, low risk portfolio. Do you want a high return portfolio or a low return portfolio? Which one do you prefer? Naturally, everyone says, I'd like the high return portfolio. And then you might have to caveat it by saying, okay, we can deliver that. However, just be aware that it is a bit more volatile. It does tend to go up and down a bit more than the others. Is that okay with you? Because you're investing for the next 30 years. yes or no. Framing is really important in this. Unfortunately, it's framed in the wrong way because you plug yourself into that, you put your details in, you get risk profiled that says how it's focused on volatility. You say, I don't want that, I don't like that. So you end up getting shoveled into the 60 or 30 or 20 or whatever. The numbers are interesting. I mean, six times return in a short period of
but
time.
no bear market in that time. Let's just keep this realistic, right? We'll see how people stick in that 100% fund when there's a proper prolonged bear market, which these funds have not had.
Have you not had your medication this morning?
No, Andy, I've not yet spoken over anybody yet, Andy.
he's off.
I'll leave that to you. Carl, do you have Irish versions of these funds?
Yeah, 100%. And look, just on the on the bond portion of the portfolios, as you know, I like them, and I'm okay with long duration bonds being in a part of the portfolio because you're right, Nick. There hasn't been any serious market correction, and when that does come, the bond portfolio should, and I would say will, smooth it out. And I'm all about keeping investors invested in what we recommend in the long term, and I think that will help. So there's also an argument, of course, if 2022 was one of the worst years ever, well then there should be a little bit of an uptick in the performance of that bond portfolio as part of those funds. So yeah, look, I think really, really good, and I think there's arguments for and against, but I think the point here is really, if we're going to recommend stuff to clients, it's what can we keep our clients invested in is probably more important than actually the specifics, as long as we are predominantly invested in equities.
In the wealth engine. Yeah, I mean, final points on this. I mean, they're not perfect, but they're pretty close too. And also, they've been reducing their fees ever since they've launched. So again, that's part of the Vanguard ethos. So,
correct.
Yeah.
And I think they're doing that again right now. But you're right, Andy. That is the exact point. Anybody shouting and roaring about I have the best and the perfect investment, it does not exist. Does not exist.
Okay. Thank you. Right, 12 minutes in and we've done one topical tidbit. Smithy, I listened to this as well, and the guy was talking tripe. Tell us about what the guy was talking about.
Well, the origin of this is I was contacted by a TRAPist, an avid fan and listener called Steve Newton. I have his permission to share his information. He's very keen to be part of this expose, if you like. Interestingly, Steve is not a member of our wonderful profession, but he's an avid listener. He works in a different industry, but he likes trap and he tunes into it and he listens and watches other personal finance podcasts. One of which is something which I hadn't come across before, Damien Jordan, who apparently is a pretty good personal finance YouTuber. And Steve was keen to sort of have our take on this, and actually specifically said Nick's take on this, because Damien Jordan recently on his YouTube podcast interviewed a gentleman by the name of Paul Todd, who's the head of Nest Pensions. And Nest, Carl, you might not know this, but our big auto-enrollment schemes across the UK. Nest are one of the biggest providers of auto-enrollment, and they currently are responsible for managing £45 billion sterling.
Is that what they've got up to? Wow.
Yeah, of sort of pensioners, people who are in workplace pension schemes accumulating for the long term.
Yes, it's the default if you don't want to go to an insurance
kicking
company.
in here later on this year. So yeah,
Brilliant.
very interesting.
So
This, yeah.
Okay, so Paul Todd is obviously a person of influence at this company. Apparently, on this interview, was saying that the best returns are available through private equity investing, and illiquid investments will do better than investing in equity index funds over the long term. Bear in mind his, again, responsibility and position of influence over 45 billion of long-term pension holder savings money. I thought that was interesting. I thought arguably, I mean, my immediate take on that is what part of the last 50 years of academic research and just independent research, evidence, reports, any number of things has he missed throughout this? Because there is little or no evidence that supports his view that investing for retail punters, people saving £300 a month for the next 30, 40 years, that investing in illiquid assets and private equity would be the more appropriate strategy. So arguably, yeah, I don't know this gentleman, but a pretty reckless statement, I would have thought. What do you think, Nick Lincoln? What are your thoughts? Because Steve wants to hear.
Steve Newton wants to hear what Lick Lincoln thinks about this.
Correct.
This interview. I listened to it, and I think the guy was. I think it was a bad thing to say. There's definitely a push for private equity. It's been the theme du jour, hasn't it? All the trade press. It comes in the first few months, or the last few months of last year, and the first couple of months of this year. It's been various articles about private equity. There's obviously a groundswell trying to get money into it. Maybe it's because the UK listed stock market is just becoming less and less relevant. I don't know. I think nonsense. Just this has got to be a plain vanilla. Nest has got to be a plain vanilla, highly liquid, highly transparent place. It's bad enough these people invested in Nest are going to have no interest in pensions by and large. I know that's a sweeping statement, but they really are not going to have an interest in pensions. The last thing you want to do is put them into something where it could go theoretically very wrong, illiquid. I think Nest has got one global equity fund, which is a Sharia compliant fund. That's where they should be putting the money. Garbage, Mr. Newton, is my opinion.
There we go.
Did the interviewer push back, Alan, or did he?
I didn't listen to it. According to Steve, he said he came across like he was biting his tongue. He wanted to push back, but he allowed the guy to continue.
They're quite good at Making Money podcast. The two young chaps that run it, they're quite good actually. They're quite disagreeable. If they don't, I listened to it. There was other things they pushed back on him about how the costs are too high because Nest does levy an initial charge on contributions and so forth. They were quite aggressive about that and quite aggressive about
their 1.8 or something. 1.8.
Yeah, but they didn't, as I recall, push back on the private equity thing. Which perhaps they could have done. But that's a good podcast, Trappist.
Nest don't yet allocate any money to private equity. They don't currently allocate any of their 45 billion to private equity, though. Or that wasn't clear.
Okay. No, they're thinking about it. That's right. That's right.
Okay. Fine.
No, it's definitely they're not doing it, but they are thinking about it. Okay. Well, on a similar vein, we'll maybe move on to the third topical tidbit because this is another company saying no to a very in-trend, it's not an asset class, it's a currency. But basically the head of Vanguard, not the head of Vanguard, but a high-up person at Vanguard. Now, this person's name is Janelle Jackson, not Janet Jackson, but Janelle, Janel. I'm not sure if that's a lady or a man. I'm going to guess it's a female. This lady, Janelle Jackson, she's global head of ETF capital markets and broker and index relations at Vanguard.com. And in this long Vanguard article on the Vanguard corporate website, they basically say we are not doing Bitcoin or crypto. It's quite a long article, but there's one line from the article which resonated with me. I know you read stuff that validates your own opinions a lot of the time, but quote, in Vanguard's view, crypto is more of a speculation than an investment, end quote. Which coming from a brand as powerful and as dominating as Vanguard historically has been, certainly, I think that's quite from my point of view, a refreshing stance to take and to be that honest about it. Because obviously they're going to miss out on a big bit of that ETF Bitcoin slice. Any thoughts about that?
No, I might just kind of slide into the next part, the next topical tidbit, because they're connected, Nick.
Sure.
Put in.
Let me then just.
Yeah, sorry.
So that's fine. That's a kind of almost an ethical or a moral stance that they've. And Vanguard of all, they remain a mutual company. They're kind of for the. They're far less, I would say, a commercially aggressive beast than the bigger fund manager in the world called BlackRock, who are all in on Bitcoin and Bitcoin ETFs. And who've clearly taken a different stance and seem to understand more of the underlying issue. But BlackRock always, in my opinion, they've got an eye for the main chance. BlackRock jumped on the ESG bandwagon in a big way, and I've noticed they've jumped off it.
They're all jumping off it
recently, and they are all in now. They've got a replacement one called Bitcoin. I would just say one thing. I mean, probably we'll come back to this later on in the show and as we go. I would say there is a difference between Bitcoin and crypto. Bitcoin would not see itself as a subsidiary part of crypto. Crypto and all these crazy tokens and coins and Trump meme coins and stuff is a different animal. But Vanguard are perfectly entitled to their opinion, and that's fine. And they certainly would have lost out significant future revenue by avoiding that asset class. But yeah, fair comment.
An interesting quote from Larry Fink of BlackRock. He previously referred to Bitcoin as an index of money laundering. Today, he sees it as a legitimate financial instrument.
Yeah.
So there you go.
But
Anyway,
to be fair, you can change your mind, which is
you can change
you know,
your mind, but you
smart
can't,
move.
you can't change your values. And this is one of the
agreed.
things that is
Nice.
really beginning to...
I'd say he's changed his mind there, not his values.
I don't know, does that man have any values? But anyway...
There goes the
think this is-
sponsorship from BlackRock.
Yeah.
No, I think this,
Inbound from legal letters from BlackRock. Yeah.
Yeah, no, guys, this whole cryptocurrency thing has gone bananas. And if people can't see that this is the greatest bubble of all time,
Totally with you. Totally with you on that.
right. So I've shared two things that will be in the show notes. First of all is something that came across my LinkedIn feed from Coinbase Asset Management. And I'm going to read a couple of things now, so just forgive me, right? So they all goggles have to go on for this. Coinbase on their LinkedIn post. We believe the future of finance is on-chain. Maximum efficiencies will happen with technological adoption when assets are natively digital and credit lives on-chain. The opportunity to work with Apollo Global Management, Inc. and securitize and invest in their tokenized fund is an exciting leap forward. Okay, I have no idea what that meant. And then... absolutely none at all. And like nobody should know what that means because that makes no bloody sense whatsoever.
Word salad.
And then there's a podcast from two folks who interviewed Eugene Fama. Now, this is about cryptocurrency, and Eugene Fama, widely considered the father of modern finance, as we would know because he's involved with Dimensional, predicts Bitcoin will go to zero within 10 years. Now, I will say that...
That's a bad prediction, I think.
that
But what do I know?
maybe he could put across his views a little more humbly in the podcast, right? So I will say that. But if you actually go on to this podcast, link in the show notes, and read the summary of the actual podcast, there's some absolute gold in there. Legendary investor Ray Dalio called crypto a bubble a decade ago. Now he calls it one hell of an invention.
Yeah, he's another one. He's another slippery bugger.
I read the Larry Fink
Allowed to change his
quote,
mind.
and less than 36 hours after launching his own cryptocurrency before his second inauguration, President Trump appeared to have made more than $50 billion on paper for himself and his companies. During his first term, Trump called crypto not money, whose value is highly volatile and based on thin air. So I just think that there's so many people getting absolutely and utterly carried away with this thing. I'm not sure it'll go to zero. I think that's probably too harsh of a prediction. But I think the more and more I read about this stuff, the more and more... the first quote I read out, like, I haven't a clue what's happening here. I just don't have a clue what's happening here. But you talk to me about Vanguard life strategies and all day long. I can understand it, I can recommend it, and I am confident that my clients will make money out of it in the long term. There's no possibility that you can lose all of your money by investing in Vanguard life strategies or something similar. With cryptocurrency, you see the volatility every single day at the moment. It is absolutely crazy. What Trump did was an absolute disgrace. What they're all doing is absolutely disgraceful.
TDS.
You should get off the fence, Carl. See what you really
Capital
think.
Isn't is the name of the podcast, isn't it?
Yeah.
Bit of a
I'm going to mention this later on in this podcast. This is going to be a little bit of a recurring theme, and it will come out. And I would just repeat that thing. Don't conflate Bitcoin with Trump coins and meme coins and shit tokens and all that stuff. It is a different technology.
No,
and
so I accept that.
We just need to understand is the key thing. What there is right now, I enter this whole thing from a spirit of curiosity to say, what does this mean? What is the whole framework that exists? And you could say that exactly the same thing. It's all built on nothing. The British pound, the euro, the dollar. What's that built upon? It is an endless supply, trust and governments. and whatever. It's just you could level
it
the
was
same
made up
thing about a lot
someday,
of all currencies, all central bank controlled
I like
currencies.
what you said there, Alan. I do, and it's very, very valid. My issue here is that they are being conflated, and people
I
are
agree.
investing in things that they do not understand because they think they're investing in Bitcoin, for example, or Ethereum, and they're not. And there's like. So if a client reads out that thing to you, you're kind of going, gee, I don't really understand that. That just please everybody, please every single financial planner out there, just say to your clients, I haven't a clue what that means. That's actually a load of old shit because that makes no sense whatsoever. But have the balls to say it. Don't pretend that you know what this crap means when you don't.
Saying I don't understand is a superpower. Just having the ability to say that and not try and be the expert.
Yeah,
you
why
don't
would
lose
you?
face. I don't think you lose face if you say that to someone. I don't understand it. Next.
Yeah, no idea.
Okay. Right. Thanks, voice, for that. So next one is me. So I think it's me. Yes, it is me. So this might be just dying legacy media floating stuff out to get the clicks, but there is apparently there's some idea gathering steam that
Momentum.
UK cash ISAs are seen by some in the wealth management area, fund managers and so forth, as being sort of holding back the UK stock market, and we should scrap cash ISAs to get people investing that cash in the UK stock market. It seems to me it's slightly insane. This is also a classic example of the problem we have in the UK and the West, but I think really in the UK more than anywhere, and Douglas Murray has spoken about this, it's our focus on second order problems. Now the sort of lurid example of the minute is we have these industrial RAPE gangs in the north of England, but that's not the problem. The problem is Elon Musk has spoken about it, and so everything focused on Elon Musk and not the big issue. The big issue with our stock market being now less than 4% of world capitalisation is not because Mrs. Miggins has got £16,000 in a cash ISA. It's because we're over-regulated. Companies do not want to list here for the hassle. They are delisting because there's too much hassle. There's an anti-corporate, anti-capitalist mindset. We're taxed to buggery. Why would you list here? But no, the problem apparently is because Mrs. Miggins has got her money in cash ISAs. And to say that we're going to get rid of cash ISAs and she's going to put her money into GlaxoSmithKline and we're somehow going to recover the UK stock market is so insane. All Mrs. Miggins will do is put her money in cash still, but leave it in a taxable account. So I'm not sure whether this is just them floating a boat here. I really hope not. Yes, there is loads of money in cash ISAs, and for a lot of people that's probably not wise, but for a lot of people that's probably all they've got. And to sort of corral them into saving. Let's save the UK stock market by slashing regulation and taxes, not by getting Mrs. Miggins to put her bloody pot into the market. There you go. There's a rant.
You should give yourself
Very
that
good.
round of applause.
Very good. Round
drop,
of applause, Nicholas. You can give yourself a round of applause. You have my
give
permission.
That's a bit. No, I won't do that. But thank you.
But you're absolutely spot on. You create an environment which is pro-business and encourages people to set up business, to grow companies, to list them, float them. You don't need to dick around with ISA allowances and stuff. The world will flock to your door.
No, just. Yeah, sorry, go on.
That's it.
Yeah, the Times also picked up on this. So last year, 41 billion went into cash ISAs versus 28 billion into stocks and shares ISAs. I'm a massive fan of incentives drive behaviour. So if they did put the ISA allowance down to 5,000 on cash and 25,000 on investments, we would see a sea change. And I'm not saying it's just because they all direct that money to the UK stock market, but it will certainly promote a saving and investing culture and behaviour. So I'm a fan of them editing the numbers and balancing it between each other, as in reducing the cash ISA limit and increasing the investing ISA limit. So I think that's good news from the government, but who knows what's going to happen.
Hockey dokie. Right, just conscious of time and the fact that we've got a guest coming on this episode 64 of the Real Advisor podcast. So this is both the Story Channel and Ultra. You're both going to have a stab at this one, looks like, according to the agenda. Abrdn selling its financial planning arm.
Alan, you're a bit confused. Did you not pick up on that, mate?
No, I saw it.
That's his
I saw,
okay.
I saw that you put it up on the list, but
he's had a busy weekend, people. He's had a bit of a celebration. We're not going to talk about it. No, we're not going to talk about it.
So what do you think about this?
What do you think about this? Enough talking about me. Let's talk about you. What do you think about me? Okay, so Abrdn, the old Standard Life, have put up for sale. They previously, I don't know if they bought a few companies and amalgamated it, and it was called 1825. That was when Standard Life was founded, as you very well know, Alan.
Day one,
and then
day
I
one.
was there. Yeah.
Day one. Yeah, he's had a big celebration this weekend. Jesus Christ! And then they rebranded it to Abrdn Financial Planning type thing. Last year they lost 34 million. Yeah, Abrdn is one of the dying brands in our space because they're predominantly make their money through active management and high charging.
Where does Phoenix come into all of this?
Oh,
Phoenix,
man, that's a whole other...
Phoenix run Standard Life's old life and pension book. Is that right, Alan? I think that's right.
Yeah.
Phoenix
apparently
have bought loads
the
of
brand name Standard Life. That's what was really confusing because they rebranded to Abrdn, and to much sort of merriment and mirth because they dropped the vowels Abrdn, Abrdn, and paid about £50 million to some agency to do this, and it was met with
so Standard Life in Ireland are owned by Phoenix.
Yeah, so they sold the name.
That's not Abrdn.
No,
that's not.
It's not. It's Phoenix basically. And all of a sudden, I see all these posters on bus stops and stuff saying, "Get your Standard Life pension here." I thought, hang on a minute, but it's a different company. Because guess what? Actually, despite everything, the Standard Life original brand from 1825 was worth something. It was a listed business. It had a couple of centuries of history. So they thought they would just drop it. But no, they didn't just drop it like some companies do. They sold it. So that that's sort of
it was a very easy brand for broker consultants to flog their wares to IFAs, wasn't it? At one stage,
it was.
Easy. Anyone could do it.
Alperton, whoa, Alperton. I can see my wheelbarrow filling with props signed by the weak and willing. I was 21
and the rest
when I owned Alperton.
Glory days.
Come on, Ireland.
Gold-plated wheelbarrow walking up and down the streets of Alperton.
I think the biggest, just to try and corral this slightly back onto, I think the biggest story is yet again, we're seeing this thing with these firms with big pockets buy financial advice businesses, thinking they can somehow make money out of them, and then 3 or 4 years later on, they divest them at huge loss.
Yeah,
rinse and repeat. I mean, history doesn't repeat, but it rhymes. And this
we should buy it and call it Trap.
A part of
financial planning. I mean, we'd do a better job at it than most of these people that are, these lifetime corporate warriors that take over companies because they, worked it out on a spreadsheet.
Well,
the reality is a lot different.
This is the reality, and having, as Nick's just reminded me through that wonderful jingle, I've lived both sides of it. I've lived in there 14 years at that big corporate behemoth, and it's quite interesting because when I became an IFA, in my mind, I thought it must be. I used to, call on IFAs. I thought it was really easy. All they do, they go play golf, they meet a few punters, they flog a few pensions. It's not difficult, and I think there's a degree of the mindset that exists in corporate life. That they've got all the systems and structures and processes, and they go, well, all we need now is to take control of distribution, as they call it, and that's a whole other story. I hate how they call it distribution because we do a lot more than distribute. But that's the idea. You see, so they do it, and it's a well trodden path. This happens so many times. They buy up distribution. You spend a fortune. They overpay for companies, and they work out. There's a lot more to it. There's a culture that exists in the planning community. There is, as Nick often says, there's an art about it. It's not just spreadsheets and P&Ls and profitability that corporate life revolves around. That's just the nature of particularly big listed companies. And it's inevitably just very, 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 very difficult to maintain that independent, creative, entrepreneurial culture that exists in planning businesses whilst you're owned by a huge company. And that's the rumor. They're putting up for sale. They'll sell it, no doubt, at a significant loss.
Yeah,
what was the numbers? What was the headlines?
Just on that, Alan, what is this worth and who wants to buy it? All the advisors are going to leave, all the staff are going to leave. It's losing 34 million a year. The other thing that's quite interesting, they mentioned that how exactly?
Was it losing 34 million on 26 million turnover or something?
I don't know. Again, it's
16-year bull market. 16-year bull market.
That has to be exceptional items, guys. That's an
I
accounting.
know, Carl. Yeah,
impossible.
Yeah. Write-downs and accounting trickeries and stuff. The other thing that is definitely not going to be the case. They've only earmarked £299,000 provisions for clients where they didn't receive their contracted services. This is missing annual
luck.
planning meetings, which
Good
is
luck with that.
total BS. Bearing in mind,
300 grand.
Bearing in mind,
What
St
did
James's
SJP
Place earmarked.
do?
St James's Place, I'm
$500
going to make a guess. They're better organised than these jokers, and they've earmarked 462 million. I know the numbers are bigger. They've earmarked 300 grand. That'll be one client. Are these people insane? There's one client that they've not seen for 9 years. They've had 3 million invested. All of that money's coming back. Oh no, we've earmarked 300 grand.
We're not going to buy it, so are we not?
This is an absolute
Yeah.
lie.
Changed our mind. It's like-
Yeah. We withdraw the offer.
Like
Yes.
most of our ideas shut down.
Not quite so good.
Okay.
This is not an asset. This is an insane liability. So who on earth will buy this? Someone will rock up. Anyway, we'll see.
I don't know.
Okay. I'm just conscious of time, guys. Thanks for this really, really good high energy episode so far. Thank you. Voice.
welcome.
Dan Haylett, friend of the show.
Yeah, I mentioned that I did a kind of client interview story the last time, and it's gone down really, really well. And I actually did another one, and it's going to be really good. But Dan Haylett interviewed a client of his on his podcast, and I can't remember. I'm sorry. What's the name of the podcast again? Someone
Wealth
might
of
find
Common
it there.
Sense.
No, that's
humans
Ben
versus
Carlson.
money. Humans versus.
Oh, sorry.
retirement.
No, I'm in the next thing. Sorry.
Yeah.
Yeah.
The humans versus retirement.
Yeah, and it's brilliant. And his client actually was in the financial services industry in, I think, kind of investment management, but still employed Dan. And they have a chat about the kind of year-long process that he went through. Really brilliant interview. I highly recommend. I'm sure you know what I think. I think everyone should be doing this for all of their clients. If you're a financial planner, there are loads of clients who love what you've done for them and tell the stories. But this particular guy was very eloquent in how he described where he was and I suppose the process that himself and Dan went through. Really, really good. Great client story. Tune in to Dan's podcast. It's brilliant.
Okay, great stuff. Thank you. So, right, the next point was the one that's what I misread. My one is A Wealth of Common Sense by Ben Carlson, who's a US financial money author,
Advisor?
blogger kind of guy.
Yeah.
And he just writes these very nice essays, very good quality. He's one of the better ones. I think him and Jason Schweig are the two American authors I like the most. And he's just put out an essay called The Perfect Level of Wealth. And it's on this bigger subject that I think we're all aging. Obviously, our clients are aging. They're coming to that word, that zone. You might want to call it retirement. You might want to call it financial independence. But the bigger question, the question that's becoming bigger and bigger and bigger
Third act.
is not what are you retiring from, but what are you retiring to? Yeah, the third act. And this essay is about that and about how people who do retire with oodles of money just aren't happy. So the founder of MVMT movement, I believe that's short for, they sell sunglasses and other shit like that. He sold his company for $100 million at the age of 27. This guy says, fast forward to now, I've been separated from the company for 2 years. I'm 31, single, and never have to work again. I've also been lonelier than ever and deeply depressed. And it's this fact that and I'm not going to read it out because it's a long quote, but basically the sub thread of this article, the underlying thing is we have to have purpose, and we don't understand quite how work gives us a real sense of purpose. And there's one other guy in here, if I could say it, the guy who made even more money than that. He's a guy who sold his company for $975 million. And he's saying that I have infinite freedom, yet I don't know what to do with it. And honestly, I'm not the most optimistic about life. And then Ben Carlson closes it off. Bit of a reach this, but he says, I'm overgeneralizing here, but the sweet spot for being rich but not feeling overwhelmed by the pressure of the wealth is somewhere in the $7 to $10 million range, which, so people that probably have got enough but maybe don't know. But just interesting, money does not buy happiness. It buys you choices. But for a lot of people, and driven people who build really good companies that sell for lots of money, they are, as I just said, they are driven, right? They are going to be like restless souls. So it's not all just about the money. And that's something that we need to incorporate, I think, when we're talking with clients who are selling their businesses. It's not just, oh, well done, you sold your business, we've done your financial plan, you've got enough. Right. Those 70 hours you were flogging to the business for the last 10 years.
What are you going to do? What are you going to do?
Think about it.
How are you going to fill your time? Yeah,
This is just a constant recurring theme on my other award-winning podcast, The Bulletproof Entrepreneur.
You've got another podcast.
And honestly, one of the reasons I started that is because I used to have these I still do have these conversations with those business owners who sell and exit, and they become clients of ours, and you go through that. And there's, quite just almost surprising but then on reflection, not surprising. Real life stories. The one that I always remember, this guy, Mike Ames, who sold a recruitment business, and it's public information. He sold it for 26 million. So he's above that. He's not in the hundreds of millions, but 26 million is enough for most people. And he very candidly went through his experience, and he said, I had to have therapy. I said I couldn't get out of bed in the morning. I had literally no purpose. And the kind of the even more challenging thing is no one's get any sympathy for you, because everyone around you says, "What the hell have you got? I wish I had your problems. You got 26 million."
Sorry, storyteller, still talk over you. Ultra, do you have our guest's mobile number? Because he's waiting in the lobby. If you do you want to send him a message and just say we'll be like 4 minutes or 5 minutes, please? Thanks.
Yeah.
Okay.
Yeah, it's a good. I haven't read that article. I shall certainly.
It's really well for younger advisors. Just subscribe to Ben Carlson's A Wealth of Common Sense, and it'll just land in your inbox once a week. Yeah, it's very good, isn't he? He's one of those good. He just knows how to write.
Yeah. Okay. He comes out the banger. Yep.
Yes. Smithy, Hargreaves Lansdown, Mark's own homework.
Yeah, I mean, this is one that it comes up on a regular basis. I just saw it again, another article. You know, these situations where fund groups, fund managers and platforms are effectively expected to, what I call, mark their own homework. They've got to do a value assessment and write up a value assessment. And it's just, I mean, you could name any of these companies. The one that came up, it was on TrustNet article, Hargreaves Lansdown. And it just goes through, and they're asked to look at it. And guess what? On all these various metrics, investment performance against the benchmark, costs against market averages, and a bunch of other things. And they mark their homework, and they've come up with a big long list. Not one of the funds listed gets a green light. It's sort of the green, amber, and red. And their list of funds have got, quite a few reds, quite a lot of ambers, quite a few, a few greens. Not one fund was available to tick all the particular boxes. And then inevitably there's a commentary that comes with it, and they come back and they say along the lines of, well, going forward, we're going to, readjust the portfolio, hire new portfolio managers, whatever. And I just think, what is the point of these things? It doesn't seem to be any consequence. You mark your own homework, and even under pressure, you say, yes, we know that it's really bad, and it's underperformed, and it's expensive. But going forward, we're going to do this, that, and the other. So don't worry, back to work. Nothing really happens about it. It's a bit of a waste of time.
They obviously want it to come out on page 48. So go on, Nick.
I was going to say, do you think that US wealth managers and US fund groups have to go through this nonsense? No,
exactly.
They don't. Here's another example of why companies, why bother listing?
Exactly.
Why bother? Come back to the point.
The market should tell you if it really is crap year after year. Then the likelihood is less people are going to invest in it.
The irony with HL, they've had to produce all this crap that we think is a load of BS, but their company is amazing. It's getting bought and taken off the US stock market, the UK stock market. Sorry, they're one of the most profitable FTSE 100 companies, and they're getting taken off the stock market. So again, all the good companies are leaving, getting bought out. Great value.
First order problems, but let's get Mrs. Miggins cash eye so she can bring back Hargreaves Lansdown to the FTSE 100. Good stuff.
They have a good slavery policy as well, I believe.
They have a fantastic slavery policy.
Brilliant slavery.
I know somebody used to work for them.
I mean,
they'll
be
throwing statues of Peter Hargreaves into the river.
Yeah,
that's what they do down Bristol way. Him and that other guy. Right, Robin Powell, active fund managers.
Yeah, did an interview, The Evidence-Based Investor. I posted it on LinkedIn. Where do active fund managers invest their own money?
God.
Yeah, everyone should watch it. It's a nice short video, and you'll not be surprised to hear that they don't invest it in this particular study. They found that the active fund managers didn't invest their own money in their own funds. It was pointed out to me by a few people on LinkedIn that, I know some active managers who invest in their own funds, so yeah, I was going to reply, and then I went, okay.
Life's too short. Life's too short. Okay. Okay, que sera with that last point. So, 44 minutes in, and we've got a guest, dear Trappist. We have another guest on the Real Advisor podcast. This guest is a chap called Barney Whiter. He's also known as the Escape Artist. And then we're moving on to the meat and potatoes now. We covered the FIRE movement, Financial Independence, Retire Early, in episode 30. We gave it a bit of a good going over. And now we got one of the people who's very much involved in it and very much respected in it. And I'm going to let him into the room now. Hopefully the software doesn't crash. So we're going to let in Barney Whiter.
Hi, There's somebody at the door.
Let's let Barney in.
Come on.
Barney playing that.
Not guilty. Not guilty.
Mr. Whiter, hello.
Oh my goodness. What sort of operation are you running here? Like, my broadband settings block porn and they block Riverside.
Yeah, well, we have a
there's a
separate
very good
podcast that
reason for
involves pornography. That's why we use
Both
Riverside.
of them.
Well, you managed to make it in. You managed to make it in, Barney. Thank you very much. Andy, do you want to give the TRAPist a little bit of an overview of the escape artist?
I will. Barney, your volume's a little bit loud in your headphones. Maybe turn it down a little bit. It's coming back through your mic. I'll give him a little telling off before I introduce him.
Nice. It just sets the tone.
Barney is
Barney
is a close personal friend of mine.
Oh, God.
There you go.
Thank you, Nicholas. He's appeared on my my other podcast, Maven Money. He's come on a couple of times. He's a financial coach, non-regulated to end consumers. He writes a lot. He's very outspoken in the financial independence, retire early movement, however you want to slice and dice it. And I thought we'd get him on to have a chat with him today. Are you ready to go, my friend?
I am. I've just turned myself down a little bit. Does that make a difference?
I think that sounds a bit better.
That's
yeah,
great. That's great.
My
Thank you.
my audio's now not coming out of your headphones. So all good. So welcome to the show, my friend. How are you?
I am very well indeed.
Good. Where are you speaking to us from today?
From downtown Farnham, the centre of the known universe.
Superb.
Is that Hampshire?
Hampshire-Surrey border. So I'm actually in Surrey, but it's close to Hampshire.
Hampshire is older than, I think, it's one of the oldest counties, and it's older than most of the European countries. Did you know that, Barney?
Well, Winchester is, Winchester is like an ancient seat of like Anglo-Saxon kings. So I'm trying to like tap into that tradition.
Right.
Very nice. Okay.
Going well so far.
We'll get back into the nitty-gritty subject of personal finance. So yeah. So what inspired you to pursue the FIRE movement? You know, what were the biggest challenges you felt along the way? We'll start with that one.
Yeah, well, I didn't follow the FIRE movement because when I started, I didn't know anything about that. So, I mean, I got on this. How did I get on that particular path? Well, you know, my parents got into a little financial scrape back in the day. So in 1981, when I was 11, my parents bought the biggest house that they could afford, borrowed as much money as they could. And that same year, interest rates went to 17% and they were a little bit screwed. And so my dad had to like stop buying beer and brew his own awful, evil homebrew, cancel the newspaper, didn't go on holiday that year. So my takeaway from that, you know, it was fine. You know, no one died. We didn't get made homeless. But I took from that little episode that it was kind of a bad thing to like be in debt. It was a bad thing if the bank can take your house away, and it was kind of good if you could get yourself mortgage free. And so like from that point onwards, I made a series of decisions that kind of took me in that direction. So I kind of followed the money. I followed the money as a lot of people did in the 80s and 90s. So, you know, I chose to do economics at uni, and then I trained as a chartered accountant, and then I went and worked in corporate finance. I followed the money.
Nice.
Okay. Yeah, I looked at your website, Barney. Really nice. Loads of things on there. You've got and if I'm wrong on this, by the way, shoot me down. But you've got a family.
Yep.
Okay, because one of the things I often think about, and it's just me probably because I'm just the way I'm wired, but the FIRE movement, and I know you're saying you weren't originally inspired by it, but I think you're certainly looked up to within the FIRE movement. A lot of it seems to be delaying gratification now for this idea of saving enough that you can walk away from paid work earlier.
Yeah.
You seem to have pulled it off. You seem to have balanced it, but how did you manage that? Okay, it's obviously easier if you're living in your mum's basement, you don't have children, and you're just shoveling all your money into a pension pot of 50% of earnings or whatever your rule of thumb is. How did you pull it off?
With some difficulty, with some pain, with some difficulty, with some regrets, with some grief along the way, with some burnout along the way. So yeah, no one said it was going to be easy, right? But I had 3 kids, and so that in itself is a big challenge. And, I wanted to have the best of both worlds. I wanted to have a sort of nice middle-class lifestyle, and I wanted to achieve financial freedom. The way I had to square that circle was by earning more, earning, much more than like an average salary. So I was kind of in a profession, in a world, in a sort of like middle-class bubble where people were making a lot more than normal average income, but I didn't let my lifestyle inflate up like a lot of those people did. So I was kind of earning high and spending low and investing the difference.
Barney, can I ask you for our audience who aren't familiar with your work, if you could summarize what are the kind of key principles, whether you call it FIRE or just your version of this kind of way you operate, what are the few things that you would advocate and you would obviously be writing and talking about?
Yeah, I mean, the 4 principles, the 4 pillars of financial independence are 1, earn more, 2, spend less, 3, invest the difference wisely, and 4, know how much is enough.
Okay, and so that sounds absolutely perfectly rational and sensible, and it's probably something that the 4 of us and many others would 100% advocate for. Why is this considered to be different to mainstream financial planning, which is what it's about: accumulating, saving, working out how much is enough, and knowing and optimizing for investing, tax planning, all those things. Well, I know you're not saying you're necessarily the kind of the poster boy for FIRE, but there's a community who kind of adopt these things.
Yeah.
Tell me I'm struggling to find out what's the difference between what is just core, sensible financial planning.
I think it's the lengths that people are prepared to go to. So it's how extreme are you willing to go? And I was willing to go extreme.
Okay. So give us an example of what you did or what you sacrificed.
So, I mean, in terms of the job that I was doing, I was a partner of a big firm in London, and so I'm working God knows how many hours a week in like mergers and acquisitions advice. So I'm working 80 hours a week. I'm traveling. I'm staying in hotel rooms. Not seeing the family for quite a lot of the time. So I'm earning at, I'm making those sort of extreme career decisions. I'm operating in a sort of an extreme career world. And at the same time, then when I'm at home at the weekend we're going for a walk, we're not going to Alton Towers, like we're going for a walk in the park and we're going for a walk in the woods, and we're kind of keeping it natural and wholesome and low cost and non-consumerist. And so, I've never paid for like a business class flight in my life, and I don't intend to. It's just these things that people end up inflating their budget to be able to spend on just never really appealed to me that much in the first place. And I was able to kind of negotiate that with my wife and bring the children up in a way that avoided, lifestyle inflation. So, a classic example of that, a lot of people who were in the job that I was in would have sent their 3 kids to private school. And once you're on that particular escalator, you're making it very, 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 very difficult, unless you're the sort of guy unless you're a sort of an entrepreneur who sold a business, it's really, really hard to put 3 kids through private school all the way and then university. And so I mean, I could have done that, but if I had done that, I would have been locking myself into that world essentially forever, and I'd probably now be, dropped dead of a heart attack, or be an alcoholic,
or both,
or both.
So it's in summary, and that's really helpful, because that clarifies it for me. You were just intentional is the word I would say from a very early stage. You knew like the next 5, 10, 15, 20 years to optimize, to achieve this. And was that what you were aiming for, this thing called financial independence, which means you didn't have to do anything. You didn't have to work, you didn't do anything. You had sufficient resources that threw off enough income to satisfy your lifestyle expectations. But you decided to do that. You were very conscious, which most people aren't, I have to say, about lifestyle creep.
Well, not just that. Can I just tag a point on that? Obviously, you've got a singular mindset, and people who do what you've done or are doing what you did, strong-willed, singular mindset. But you've also got to find a partner who's on this journey with you. And did that ever lead to tensions in terms of without going through But it takes two people to plough this furrow.
Yeah. So my constant challenge from my wife is like, what is the point of all this what is the point of the sacrifice? What is the point of frugality? We can afford it. Why can't we spend it? So I lost count of how many conversations like that we had. What I was trying to explain to her is that the job that I was doing was like a sprint, and I just couldn't see myself lasting at that until I was 67. I was going to keel over before that point. And so because I was operating in an extreme environment, I knew that it just couldn't run on forever. And when you're and also I looked around me, and I was looking at my career change options, and in some ways it just wasn't that easy for me to see a way to drop down into a sort of middle ground. I mean, I could see that I could go and work at McDonald's or be a barman or something, but I couldn't quite see a route to a sort of middle ground, sensible career alternative. And so my mindset was, whilst I'm in this situation, I've been given a gift. I've been given the gift of high income. It won't last forever. Let's fix the roof while the sun is shining. Let's stash as much as I can. Let's build. Originally, I just thought of it as like clearing the mortgage. Once I'd cleared the mortgage, I was like, okay, let's build a redundancy / retraining fund. But I just pushed through until the point where I was 43, and I'm like, do you know what? I've done it. I can quit.
Brilliant. Carl, should we bring you into the conversation, my friend?
Yeah, everyone is taking a big gulp of air now, Barney, because I suppose I've been the one that's been a little bit, I wouldn't say critical of the FIRE movement, but I've questioned it a little bit, right? And obviously as financial planners, the FI bit, I get the financial independence, because we're trying to get people to financial independence as quickly as possible to give them kind of those options. It's the retire early piece is the bit that I'm a little bit conflicted with. Having said that, I've listened to a number of your podcasts in the last while, and you seem very balanced in it. But I have a couple of questions, and I suppose one of them is you did speak about, and you've mentioned it just here today as well, about kind of burnout, and you nearly you got kind of unhealthy, didn't you? And you got yourself in a bit of bother, like. Are there sacrifices you think that you went a little bit too far on, and are there regrets? Are there things that you might have done a little bit differently if you had your time back?
For sure. So, I think essentially we're all converging upon the truth, like from different directions. So, financial planners, financial advisors, people in the FIRE world.
I agree.
We're trying to get to the truth. We're trying to get to what makes sense, what is objectively real. And, we're learning as we go. And so I quit at age 43, quit my job, had and I didn't know what to call that. I mean, I've never called myself retired. I don't like the word retired. I don't like the sort of associations it has. But but I quit, and I had to just figure out a new life, and that is pretty disorientating, actually. So this is why I don't sort of push it onto other people. It's quite disorientating to go as I did from like very structured life where I've got to work 80 hours a week. I've got this many meetings to do. I've got to fly here, fly there, keep the show on the road. To go from that to nothing, like a clear diary, you lose your anchor. You can lose your identity.
Yeah.
You can lose your structure. You can lose the sort of social, your social peers. You're the people you work with. And that's like being cut loose on the ocean in some ways. And so I did that, and I had to kind of figure out and like reinvent myself and create a new life. But that's not a very sensible way to approach it for most people.
Right, yeah.
And so if I wanted to exaggerate for effect, I would say early retirement is death, because essentially if you just lose your mission, lose your purpose, cut yourself loose, and just like go to the beach and wait to die, that's like, like that's probably not a great idea for most people.
Yeah, and this is one of the difficulties that I have had, and I love hearing you saying this, because look, there's in our world there are extremists, and in your world there are extremists, and I love that you make the point that we're all kind of coming to the truth together, and we'll kind of meet in the middle somewhere, because I think everything that I've listened to, Barney, in the couple of podcasts I've listened to you in advance of coming on today, I'd say, yeah, I totally agree with Barney, because you've never spoken about I'm just retiring to the beach and that's it. And I suppose my thing always is you need a purpose. And this, I hate that word retire as well. And I'm trying to coin this phrase, or get everyone to coin this phrase, third act. And, what does it mean? What does getting up in the morning mean? What does it look like? And what's the purpose of that day, that week, that year? And especially as I think, we're all going to live longer, aren't we? And with the, AI is going to help all of that, and the 100-year life and all of that kind of stuff. So, trying to match money to live for just a very particular till age 81 is probably, that's a bit of a risk as well. So, I think, going forward, the matching the values of what you're saying and what we're saying, I think that's kind of the sweet spot. But, Andy, I'll bring you in here, because I'm thinking we're all actually on the same page here.
Just in your experience, Barney, how many people that have sort of lived the FIRE life have retired with no purpose and have been very unproductive in society? Is that common? Is that rare? Is that a bit of both?
Everyone goes back to work. Everyone goes back to work.
Oh, wow.
Okay,
wow.
so they try it for a while. So unretirement, we call it unretirement. The unretirement movement's quite big. The FIRE movement's big, and the unretirement movement's big.
Breaking news. the RE part has been renamed back to work.
So before you joined the show, Barney, we were just discussing an article we saw by a US journalist called Ben Carlson, who writes these blogs, very good, and he was just about how money is not everything, and these multi-millionaires in the States, they just feel depressed, they're worthless, they've lost their sense of value, their sense of place, because they haven't got that thing that got them out of bed. So it's not just about the money, isn't it? It's about what are you retiring, not what you're retiring from, what are you retiring to? And it is a horrible word, retirement. We try not to use it, financial independence, whatever you want to call it. But it's a big thing.
Moving on to the next topic, and I want you to be as honest as you can here, Barney, and I know you will be. You've got your own thoughts on the financial advice profession, because you see how we work from the inside, from the clients that you work with. You know a lot of them. So, what's your thoughts on the financial advice, financial planning profession?
Be careful with your answers, Barney. We like you, but be careful with your answers.
No, hit us hard.
Go for it.
No, be as honest as you can be.
Go for it.
So I'm in my notice period back in whatever it was, 2013, 2014, and I'm kind of like looking for something, what's next, okay? And so as part of that, I toddle along to meet the nice people at St. James Place. So I talked.
You underestimate the power of the dark side.
Here we go.
So I go and talk to the nice people at St James Place, and we talk. They had this thing called the Academy, where basically they train you and they train in quotes,
Still do,
air quotes, and then they essentially set you up as like a self-employed salesman for their products. And they told me at that time that the average St James Place client was being charged 2.4%, 240 basis points per annum for the pleasure of their services. And I just like, are you joking? Are you joking me? And I saw what those guys had optimized for. You know, they were taking, I saw the other people that were applying for the process, and there were, the ladies were very attractive and the guys were very sort of sensible looking. And we were kind of being teed.
And there was you.
And then there was me. And we were teed up to be actors, kind of pretending to be financial advisors. And I'm like, this is bullshit. And but they have optimized for marketing. So they understood marketing better than any people that I've ever spoken to.
without a doubt.
So they were not dumb people at all, and very, very smart people doing things that were totally legal with the blessing of the regulator. I just thought, this is crazy. This cannot last. So I kind of expected that business to struggle, and I've been amazed at how long it's run for. Obviously, the Times and the Sunday Times have now got their teeth into their leg, but I was amazed at how long that run. So I just came to the conclusion that there was, shall we say, room for improvement in the sort of mass market of financial advice and wealth management.
So what do you think about financial advisors from a wider sense rather than just SJP in isolation? Do you not come across the work that we do in the coaching that you do with your clients, or?
So essentially the way I see it is that it's like everyone has to figure out money. Like money is like oxygen. You don't have a choice whether to deal with it or not. So there's, however many people, 60, 70 million people in the UK, everyone has to figure out money. And it's something of a hostile environment in the sense that we're plonked into this world that has been optimized for marketing purposes. So, if you just live in London and you go from the tube to your office, you've passed 100 adverts on the way. You've passed, 100 shop fronts. You've passed 100 opportunities to let the money leak out of your life. And so everyone has to figure out the money game, and everyone has to decide, well, can I do this on my own or do I need help? And if you need, and I think Andy, you've put this very well, you guys have the offer, you have the regulatory ability to say to people, we can do anything for you. So, you could just focus on running your business. I'll focus on running your portfolio. I will think about your insurance needs. You can just outsource it all to me. And so you guys can do that. And I don't do that, and I can't do that, and I don't want to do that. My point is it's a huge, huge market, and it kind of makes sense if you believe in capitalism and choice and freedom. It makes sense for the consumer to have different options available to them.
And what does the escape artist do then, Barney? Do you do kind of one-on-one coaching with people who want to try and get to this financial independence as quickly as possible? Yes,
I do.
Okay.
But what I figured out pretty quickly is that all the people I was talking to, they kind of already got the money thing sorted.
Okay.
So my average coaching client, I am talking to them about a mixture of things, which is largely career change, health, burnout, like life decisions, moving country, and they also want to talk about, you know, what they're investing their money in, but they don't want me to tell them what to do.
Okay. And typically, what does that look like? Do you like engage with them over a period of kind of 12 months, or is that entirely up to the client, or how does that work?
Yeah, so it's up to the client, but I mean, But what I realized is that if someone is, let's say someone might come to me and they're burnt out, they're trapped in a job that is kind of burning them out or running them down, and like there's no immediate exit from that. Like that's a period of time and a period of work that needs to be done. And that might include some health changes. That might include some research. That might need some like brainstorming about what else that person can do. That might require some like looking at, you know, their financial setup.
So it's much more holistic than just this holistic. FI. Yeah. Okay.
It's holistic.
And just from a financial planner, financial advisor point of view, is there a big demand for this service?
No, not really. No, it's a terrible business model.
No, I thought you were going to say, yeah.
He's honest. Barney's very honest.
Yeah. He needs to go back to work again soon.
No, I remember I went to see the St. James Place, and they said like, oh, our average person, they spend like 2 or 3 months in Barbados or skiing in Chamonix or whatever. And I'm like, oh, that sounds good.
2.4% a year.
Yeah.
Work out why.
That's a better business model. So mine's a terrible business model. Mine's awful.
Yeah, interesting. Bonnie, can I just ask you something specific? You said there that the people come to you and they've kind of got the money thing worked out in many ways. But just to clarify, and what strikes me is you're all about optimizing in every way and avoiding leakage, if we call it, in terms of just cost and lifestyle, all that sort of stuff. 100%. Does that, I mean, I'm not trying to feed you the answer, but ultimately, where does that lead you to deploy your investable capital? What sort of funds, investments, structures? Where does money end up in your life or in the lives of your clients?
So for me, I've just got a very simple like asset allocation like framework in my head, which is it can just be as simple as you have an emergency fund, you own a house, I mean, ideally without a mortgage, and then everything else just goes into like Vanguard Global Equities ETF. And right. So like that, I'm not saying everyone else should do that. I'm not saying everyone else has to do that, but it can be made that simple.
Because you'd be right if you said that.
It can be made that simple.
Yeah.
Yeah. What really strikes me is that you're kind of an industry outsider, but you've had a very close and continue to have a very close look at the inside of the industry. And it's a constant theme that we talk about. And again, the advertising you talk about, the promotions everywhere. This is an industry that loves to complicate things and make things sound much more confusing because you, Mr. punter, investor, you don't understand this stuff. Leave it to us.
Leave it to the professionals.
But if you were to just remove all that first principles thinking, distill it all down to just what are we trying to achieve here, which is as we've all agreed, financial independence is a good thing. It creates freedom, opportunity, peace of mind, all those good things. So what's the best way? So what you realize, what we've all come to the conclusion, and we're all on the same page, it is those things. It's trying to, remove or reduce debt, own your house, have cash on hand, and then invest for the long term using, the lowest cost means of engaging with that. Let me throw a little curveball at you on that, on the broadly same subject, but it's come up a couple of times on this podcast. It will again. What are your thoughts on Bitcoin?
Yeah, so I was crypto Bitcoin skeptic for years and years and years. And I only basically flipped in 2021. So 2021, I bought my first £100 worth of Bitcoin. I went down the crypto rabbit hole, and I've been, pretty obsessed with it ever since. So like, I'm not pushing it on other people, blah, 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 blah. But it is going to, but essentially this is a huge historical moment. It's a huge historical change. What Bitcoin represents is the separation of money and state.
Yeah.
And, just back in the Reformation, you had this this idea of the separation of church and state. This is kind of a similar moment, in a similarly big thing in history, that the separation of money and state. And so the idea that you can have a store of value that cannot be arbitrarily inflated, debased, confiscated from you by a powerful government is a game changer.
Interesting.
That's a good answer. That's a considered answer.
I thought you'd might say that, and it's a subject we'll come back to. It's very interesting to get your take on it, as you're not sort of conflicted by this industry that we're in, and the regulated industry who's got a particular mindset. You're just coming at this from from an open mind, I suppose. What does this mean? What is it? And you've obviously done the work to understand it more. So it's interesting that's your view, Nick.
I'm conscious that we've taken quite a bit of Barney's time, and he's actually in the office now working on another M&A deal. And he's only with us because he got an extended tea break from the boss.
He's making it all up.
Barney, thank you so much for that. Fella, do you want to hang around? We've got about another 20 minutes of the show to go, some more segments. You're welcome to hang around and contribute if you'd like to.
No, you don't want to hang around for us rambling.
Or you can jump off.
Tell me what to do. I'll stay or go.
You stay or go. You stay or go. I think you could add some value. Just Barney's website is theescapeartist.me, and there'll be a link to it in the so-called show notes. But I think we do need to move on to the next part of Trap episode 64, because we're at 76 minutes in, and it's time for Trappist questions. And I know that because I can see at the front doorbell the postie is dragging the bulging sack of Trappist questions up the drive, and we will answer some more questions. If you want to submit a question to us, do it on the pinned link in the tweet on X, or the X on the tweet, or whatever, and we will get round to them. These are questions from August last year, and the first question, I think, is from someone. Let me open this one up. This envelope is from a Patrick S, who says he's on Twitter as @Patrick. I checked that, Patrick. That's not true. You're not on Twitter. @Patrick is someone called Patrick de Leeuw, who lives in Amsterdam and is a host of shows. It's not you. So nice try. Anyway, his question is this. This is, again, deep breath. And Barney, if you can contribute to this, that's great. If you can't, that's fine as well. Hi, Trap Pack. At the outset of your career, how would you recommend navigating joining a financial planning firm for the first time? Building your client bank at that firm and then subsequently leaving it to set up your own, or going to a smaller outfit where you may have an ownership stake. Intention would be to begin with the end in mind, which we like, but undertaking this would create challenges, i.e. SJP advisor and then joining an IFA. Challenges with non-competes, exit charges, etc. This would create poor client experience and may not even be possible. Interested to hear all of your thoughts, given you have all done this at some stage. Thanks. Right. Hopefully, guys, you've had a chance to look at Pat. You haven't, Barney, but the rest of us have had a chance to look at Patrick's question. Any quick thoughts?
Well, this is a question of my first job in a financial planning type firm question, I believe. I mean, he's massively thinking ahead here, which is commendable. I would just say get stuck in. You just got to get a job. The traditional route is administration, power planning, then advising. I recommend going to work for, not a very good firm, a firm that's got a lot of wheels that are spinning. You can get involved in various different areas of the firm. If you go to a well-oiled machine, you don't realise how good it is, and then you can't learn from all the different parts of it. So get a job anywhere. I wouldn't overthink client bank and non-compete agreements. This sounds insane.
Well, I'd counter that. He's obviously is thinking about, he wants to be a financial planner. He wants to have some sort of ownership of a financial planning business. So he's looking to navigate. It sounds like his early stage career. And interesting Barney's had some experience by the sounds of things on this. That's people do talk about the academies. St. James's Place is one. There's several others out there. And there's no question, if you're from a standing start, you do get infrastructure, marketing, any number of other
Business
things.
plan.
But if you're doing that as a stepping stone, you say, I'm going to do this for 2 years, then exit and start my own IFA firm and take my clients. Well, it wouldn't be SJP's first rodeo. This is the first thing. They are pretty well buttoned up for, exiting within the contracts that the clients currently buy, with exit charges and penalties and what have you, very often, but also with your contractual obligations that you've got. So I don't think it'd be very easy. If your end ambition was to run your own independent firm, that probably wouldn't be the best route to go. Barney, was that ever talked about, Barney, when you were looking at the SJP Academy?
Well, they didn't want to talk about that. They're like,
how to leave us?
No shit.
Yeah, but it probably worked out. It wasn't going to be. What I would say again, as a founder of a business with advisors, this thing about starting and effectively leveraging all the resources that the advice firm is going to give you, then to go and set up on your own and take all the clients, that wouldn't be a great thing necessarily to do or to become known for. There are firms that will offer self-employed contracts, so you will get an infrastructure, you get sort of some admin and stuff, and you'll pay for it along the way. And ultimately, the clients are yours. You'll grow them yourself. If you wanted to leave and set up your own show, you could do so. So you just got to be careful about navigating the contractual obligations and expectations. And you don't want to be someone that's known as jumps about from one company to the other, tries to take clients with them wherever they go. I know you boys have got Nick.
As a fellow overthinker, I think this guy's well overthinking it. I think he just needs to get involved. He's at the beginning of his apprenticeship stage. When you start moving from the apprenticeship stage to mastery, then that's when you need to worry about these sort of things. Just get involved. He could be doing this for 10 years, just, hitting the streets, hitting the phone calls, having client meetings, making the mistakes. Make mistakes in someone else's time and money. Obviously, you want to add a lot of value because that's how the world works. So I think he's overthinking this, potentially.
Andy, I never thought of you as an overthinker, mate. You don't strike me as someone who suffers. No, I don't mean the derogatory for once. I mean, you strike me as someone who doesn't vacillate and think, this is what I want to do. So why do you think that's?
I'm a massive overthinker.
You don't, you wouldn't know. Just to close on this, we actually know an SJP advisor who has just joined an IFA. So it can be done. And shout out, they're both Trap fans. Shout out to Graham and Julian. So you can do that. It's not as easy as it maybe should be. And we'll leave it at that.
Well,
okay, I'm conscious we're now at 81 minutes.
Go on. Yeah, Ollie has just joined us from SJP as well.
Okay, so
we've got an
there you
advisor as well. It does happen.
And yes, the academy, the training, it is sales orientated, but they also do other stuff as well. It's supposed to be very high quality in terms of business planning and that kind of thing. So
just very quick point. The guy here, Andy's point is right. If he's at the very start, just get your head down and start working and work really, really hard. But the clients aren't being really thought about here. I know there's a one comment, suboptimal outcomes for clients or something like that. The clients need to be thought about first and foremost, and that has to be your main priority. And if you do great work for clients, no matter who you're working for, whether you're working for somebody else or for yourself, you will have no problem in your career. But I think trying to plot a course very early in your career before you've done the hard work.
Yeah.
Too early, my friend.
Yeah.
Sorry,
Okay.
I probably sound like
Just
a dinosaur
become
saying
valuable.
that.
Become really valuable to your clients, your employer, everyone.
Who knows what the
just offer
world's
value.
going to be like in 5-10 years' time.
Exactly.
Barney, can you tell them to hurry up because they'll listen to you. They don't listen to me. All right, let's move on. 83 minutes, shoot me. Let's move on to the final part of the show. This is the so-called Culture Corner.
Oh, shite.
No, it's another question, Nick.
No.
Aren't we doing another question? You cut it.
No, you dropped it.
All right. Okay.
Yeah.
It's gone on too long.
Okay. Right. Carl.
Yeah, there's a David McWilliams podcast that everyone should tune into, and this one was about the Deep Seek story, and it was I just loved the way it's kind of two Irish guys. David McWilliams is a pretty famous economist here. He's very entertaining as well as very well read and a very clever guy. But I just loved this was a real typical Irish type podcast because they were like totally and utterly they were just celebrating and giggling about these guys coming in and doing the same stuff as all the other AI merchants doing it, but at a tenth of the cost, and kind of celebrating the underdog and that kind of stuff. But they do bring in an American-born Chinese lady, and she gives some really good insights about it as well. But the podcast in general is really well worth listening to. The David McWilliams podcast.
Great stuff.
Go on, Nick.
Go on.
I don't know if other people on the call know about it. So obviously DeepSeek have done what, let's keep it simple, OpenAI have done for a 20th of the price, keep it simple. But so OpenAI have scraped data from all over the internet. It comes under this fair use policy, and I don't know it well enough. It's this fair use policy. And then DeepSeek has basically just stolen a massive chunk of what OpenAI have done, and they've got a problem with this now. And that DeepSeek was saying, well, you're stealing all other people's information under the fair use policy.
Yeah.
We'll just let you do it and steal yours. And they're like, no, but we've got a problem with that. And they're like, but you're stealing the It's this sort of merry-go-round.
You should listen to the podcast, Andy. You'd love it, because they do say that, they're all giving out about robbing everyone else's stuff.
They'll rob, and then we're just going to rob you at the end. And it's quite interesting. So this fair use policy, again, it's like built into websites and built into a lot of media companies. I don't know it well enough, but it's interesting.
But it's going to be litigated to hell and back in the US. So essentially,
you mean those companies going after DeepSeek, or who knows? It's the beginning of all this stuff.
If you're the New York Times and the FT, you're pissed off that all of these AI models have just scraped your whole data set and they've not given you a penny. So you're going to court.
Right.
Interesting times. Those, and there are agreements coming into place as well, where they're agreeing to pay for it. I mean, OpenAI have just
it's a little bit like Napster, isn't it? It's like we'll steal all the music and then we'll come to an agreement 5 years later, type thing.
Yeah, it will get worked out in the end.
Okay, next one, please, gents.
I would encourage everyone who listens to this podcast to watch a 30-minute video. It's on YouTube. It's on a few other places, and it's called What's the Problem? Barney, I don't know if you've seen this. What's the Problem? Created by a guy called Joe Bryan. And I've just had Joe Bryan on my podcast, Bulletproof Entrepreneur. He is a very smart, humble guy. He is an Oxford graduate. He was at Goldman Sachs for 10 years. He was an entrepreneur, created a business, sold it for a lot of money, and went down a rabbit hole of identifying this, as Barney was talking about a moment ago, the fundamental problem that is wrong with the money system, the economy, and regardless of whatever you think about it, it is, in the way it's delivered, it's a very professional, easy to understand video, and it's worth anyone investing 30 minutes of your time to watch, listen, and understand, because it does have an impact on our lives and the lives of our clients. Go and watch it. Link in the show notes.
Okay, cool. A new podcast I've discovered. It's been around forever. It's about 700 episodes, and they knock one out every 3 or 4 days, and they're long form podcasts. But the series is called We Study Billionaires. The latest episode is a 2.5-hour interview with your friend Andy and your friend Alan, Terry Smith. But he really goes into his childhood and everything, and he's an active fund manager. Obviously, I'm sure Barney, you've heard of Terry Smith as well. He's probably the UK's most high-profile fund manager at the moment. But regardless of what you think about active fund management, he is an entertaining listen. So
is he on it for 2.5 hours, Nick?
The show is 2 hours 25. I mean, it just started the show.
Great.
So there we go. So there's me. And Barney, by the way, if you've got one resource to give to the TRAPist that you would recommend, maybe I'll come to you last, just to put you on the spot.
I've got one. Yeah.
Okay, cool. Right, Mr. Hart, go on, sorry.
Can you not pronounce it, Nick?
Well, Naval Ravikant, but you don't like it when I start announcing the Culture Corners. It's got to be silence, so I'm trying to be silent.
Okay, so mine is a podcast. Watch on YouTube or podcast channels. Naval Ravikant, who is a very deep, wise thinker. He's on the Ranveer show, which I believe is one of the biggest shows in India, only from listening to this latest one. Lessons on growth, life, spirituality, love, family, and more. If you're a fan of Naval Ravikant, who's come out with The Laws of Wealth, he's been on the Tim Ferriss podcast, which is the most downloaded Tim Ferriss podcast. He's way too deep thinker for you boys. I'm sure Barney's listening to it, but that's my Culture Corner. Over to you, Barney.
So, my greatest claim to fame is Naval Ravikant answered me on Twitter once.
See, he's a fan.
So my suggestion, if you want to understand what's coming in the US and what the new regime holds, watch the Lex Friedman interview of Mark Andreessen. that was, I think it was 10 days ago. And Mark Andreessen is essentially the guy who has been coordinating the Silicon Valley assistance to Trump. And so Mark Andreessen is plugged in with David Sachs, the new AI and crypto czar. He's plugged in with Elon Musk, and he's kind of like, he's the sort of, in some ways, he's the sort of less visible power behind the throne.
Do you listen to the All In podcast, Bonnie?
Yes.
Yeah. So
I've watched that one with the Lex Friedman. Andreessen, my God, he talks so quickly, and yet the podcast is still about 3.5 hours long.
Yeah, because Friedman talks so slowly.
Yeah, exactly. It balances out.
That's exactly right.
You've got to do one at 2x speed and one at 0.5 speed.
Yeah, when you listen to it at 1.5, you're buggered. This one's just normal. This one's like 3.
It's good. It's good. All right.
Okay. All right. Are we there?
Superb.
Are we there? Barney, thanks very much, my friend, for coming on the show.
Thank you, guys.
Thank you, Barney. That was brilliant.
EscapeArtist.me. There you go, dear Trappist. Episode 64 comes to a close, and another pile of traps slides down the U-bend of Father Time. Thank you for your precious time. Do leave a review. Barney, leave a review, okay? 6 out of 5 stars on iTunes is mandatory. But until the next time, dear Trappist, take care out there, and we will see you on the other side. Goodbye.
Bye-bye.
Bye.
Bye-bye.
The music's not starting. Come on.
Absolute shambles.
Here we go.